Good afternoon, everyone. Today is March 4th, 2024, at 2 o'clock on Monday. Firstly, let's review last week. Last week, I placed two trades, one in gold and the other in crude oil. Unfortunately, both ended up hitting their stop-loss levels. Consequently, the account incurred a loss of $36,000. Currently, the net value stands at $63,000. Another account suffered a loss of over $3,000, which is roughly 10 times the size of the former loss. One account lost $36,000, while the other lost $3,600. Regarding last week's trades, I initiated a short position in gold. However, the market moved against my expectations. I entered the position on Thursday and added to it on Friday. Unfortunately, gold experienced a significant rally, and I had to cut my losses near 2060. This was the general pattern of trades last week. And there's crude oil as well. Last week, I also bought crude oil, but I took a bearish view on it. Why did I decide to short crude oil? Well, after analyzing the candlestick patterns on Wednesday last week and considering the 4-hour rotation, I had a sense that crude oil might have reached a critical resistance area. So I entered a short position in that zone. There were brief moments of profit during the trade, but overall, last week's trades were unprofitable. Most of the trades incurred losses, and I eventually had to cut my losses. Essentially, I didn't make much money last week. Then, on Friday, both gold and crude oil started rallying, and my positions were stopped out as they broke certain levels. So, to sum it up, all trades last week resulted in losses, and I got the direction wrong in all of them. However, having stop-loss orders in place gave me some confidence. For instance, gold rallied to almost 90 before hitting my stop-loss at 60. Similarly, for crude oil, my stop-loss was around halfway into the loss. In simple terms, the issues last week were a lack of patience and sometimes taking on larger positions for short-term or intraday trades. Sometimes, I wasn't even sure about the positions I had opened. This led to a lack of clarity in my trading approach, resulting in wrong directions. Last week, I simply misjudged the market and lacked patience. I had been waiting for a good opportunity for a long time, mostly during the latter half of the week, particularly Thursday. I entered the market because gold had been sideways for the past 3 weeks, and I anticipated some profit-taking in that area. However, the market moved upwards instead of downwards, leading to incorrect judgments. Actually, last week I was a bit misled by the US dollar, because at the position of the US dollar last week, this line drawn during the live broadcast last week, the US dollar showed strength in this area twice. I mainly thought that the US dollar was likely to rise further. What I didn't expect was that when the US dollar was strong, gold didn't fall. Gold remained sideways and even moved higher. When the US dollar weakened, gold rose even higher. It's because I thought the US dollar was relatively strong, so I thought, gold, you should be going down from here, right? But the market was just like that. This was the problem last week. I won't dwell on it anymore. This week, let's step up our efforts. Last week was just a lack of patience, and the other issue was the rolling of positions wasn't managed properly. We'll address these issues this week. First, patience. Second, we'll sort out the pacing of our trades. I've noticed that every year, my trades at the beginning of the year don't go well. It's very strange. Last year was the same. Last year, around the eve of the Dragon Boat Festival and May Day, my trades were also poor. It's always the first and second quarters of the year. I've been losing money in the first quarter for the past few years. It's very strange. Every time at the beginning of the year, I get hit hard, and then I start digging myself out of the hole. This feeling is very uncomfortable. Now back to the current market situation. First, let's look at the US dollar index. Currently, it's still in a sideways pattern, without any clear direction. Right, the US dollar doesn't have a clear direction and continues to trade sideways. Looking at the weekly chart, when it's trading sideways like this, it tends to be somewhat bearish or turning bearish. So at this position of the US dollar, the weekly chart suggests a downward trend this week. Right, this trend leans towards a downtrend. But as I've said before, we'll follow the market's movements. But it's very clear that we didn't do that last week because we entered the market a bit early. So this week, we'll try to follow the plan we discussed earlier. And looking at the daily chart, if it's sideways, there's not much of an idea at this position. For now, with the market in consolidation, we'll wait for a breakdown. If it breaks down, the US dollar will weaken. If it continues to trade sideways or moves higher, then the US dollar will strengthen. This is it. What's next? let's look at gold. Actually, regarding the position of the US dollar, personally this week, I'm inclined towards a downward movement in line with the US dollar. Let's move on to gold. For gold, last Friday saw a big bullish candle, a huge bullish move. This basically laid the foundation for the short-term strength of gold. With such a trend, a big candle like this, in the short term, either continues to move higher, accelerating the pace, or experiences a pullback for a day or two before continuing the uptrend. Generally, within 2 to 3 days, this candle should close. If it doesn't close within 2 to 3 days, it continues to move higher. This candle possesses authenticity, while a new high may be a feint. Therefore, let's pay attention to the daily chart over the next 2 days to see what pattern emerges. It could go either way, just like today's rally, followed by a downturn tomorrow. There are possibilities. So let's observe for the next 2 days and not rush into the market blindly. However, from the current perspective, looking at the weekly chart of gold, this trend is already very strong. So at present, from the script's perspective, a pullback for long positions in gold is the main theme. How to do it? Look at the daily chart. If we look at the daily chart, it's about retracing to 1/3 or 2/3 of this bullish candle around the critical resistance level of the previous 2060, which is now around 2080. If we can hold around 2060 and then retrace back, there should be no problem going long on gold. Of course, if the decline is sharp and directly breaks below 200, then take a closer look and observe. So at the moment, for gold, at the moment of making this video, my train of thought is a pullback for long positions, considering around 2060 for going long, considering taking long positions there. It's quite evident that there has been a breakout in this trend, right? It has already broken out. A pullback and going long, as long as it holds around 2050 or maybe around 2045, that's the strategy for gold this week. When it comes to crude oil, relatively speaking, my confidence in trading it is greater than trading gold. For example, how to approach crude oil this week? Let's look at the 4-hour chart. In the 4-hour chart, crude oil has already broken out of this range around the 4th. After this pullback, it slowly retraced. How to interpret this position around 83.9? If it can hold a support, there might be a rebound to the upside. In other words, around 83.9, consider initiating a buying action. Then looking back, at what position, for example, around the midline, how much is it pulling back? Around 82.9 or near 83. This is a relatively upper position. As long as this line isn't broken, this area isn't broken, the position at 82.9 isn't broken, it will bounce back. So, in this area, it's about pulling back to catch long positions. This is my personal perspective. The momentum of crude oil going up far exceeds my confidence or accuracy and probability compared to gold. So personally, my focus is on crude oil. As for gold, I'll observe more, learn more, and act less. This is about crude oil. Now, regarding the euro, it's moving sideways. There's not much to say. Actually, if I had traded currencies last week, it wouldn't have been a big deal. Trading currencies, the rhythm is fine. It's just a matter of making slightly less profit. But I didn't touch currencies last week. Once I didn't trade currencies and only traded gold and crude oil, the results were completely wrong with 2 positions laid out. In terms of currencies, looking at the euro, whether from a weekly or daily perspective, the upward momentum seems relatively strong. After a period of consolidation, it's starting to move upwards again. If it continues to rise, it will likely surpass previous highs, indicating a bullish trend. So focusing on currencies like the euro and avoiding confrontation with gold and crude oil might be a wise move. As for the pound sterling, it's also showing strength, especially compared to the euro. If it manages to break above its recent highs, it may signal a shift towards a bullish trend. Therefore, this week's strategy could involve being bullish on the pound sterling and avoiding aggressive positions. Regarding goals for this week, the primary aim is to avoid losses and perhaps break even after last week's losses. Rushing into trades or trying to recover losses too quickly could lead to further losses, so it's essential to maintain a steady and patient approach. Lastly, focusing on opportunities presented by the Japanese yen could be lucrative, especially if there's a rally in the Japanese stock and currency markets. Overall, this week's strategy revolves around learning from previous mistakes, being cautious with the US dollar, bullish on gold against the US dollar, and prioritizing trades in crude oil and currencies.